I purchased a coffee vending machine for my shop for rupees 5,000 and the life of this machine is estimated to be 5 years. So according to the going concern concept which we have studied earlier, my business is assumed to continue for a long time period. And because I will be accruing the benefit of this machine for the next 5 years, so the price that I paid to acquire this machine will be divided equally for the next 5 years. And every year in the expense as depreciation, 1/5 part of the machine will be charged and the depreciation amount will be deducted from the value of machine to show the leftover price in the asset side of the balance sheet. And this is how the accounting of this machine will be done. So 1/5 part of rupees 5,000 comes up to rupees 1,000. So this value will be shown as depreciation and will be deducted from the value of machine, that is from rupees 5,000. So we are left with rupees 4,000, which will be shown as asset in the balance sheet. Next year again rupees 1,000 will be charged as depreciation and from 4,000 we'll deduct this 1,000. So the leftover value of the asset is rupees 3,000. Again next year the same procedure will be repeated, that is we show rupees 1,000 as depreciation and the value of the machine will become 2,000 and will be shown in the asset side of the balance sheet, and so on so forth. So by the end of the 5th year the value of machine becomes 0 in the books of accounts. Now I give a little twist to this. Suppose by the end of the 2nd year the market price of the machine becomes rupees 2,000 because some new technology in coffee vending machine has been introduced in the market, so the old technology becomes obsolete and henceforth its price reduces drastically. So the market price of this same coffee vending machine becomes rupees 2,000 at the end of the 2nd year. So what should we do now? By the end of the 2nd year, should we show rupees 2,000, which is the current market price, in the books of accounts? Or shall we continue with rupees 3,000 that we calculated on the basis of the cost which we paid to acquire the machine? So the accounting in the books of accounts will be done on the basis of the past price that we paid to acquire the machine, and hence by the end of the 2nd year we will be recording rupees 3,000 and not the current market price of the machine, that is rupees 2,000. Thus accounting on the basis of the cost paid to acquire a particular asset is done under historical cost concept, and according to historical cost concept, an asset is recorded at its cost in the books of accounts, that is the price which is paid at the time of acquiring it, and we ignore the current market price of the asset. And why do we do so? Why don't we record the asset on the basis of the current market price? The reasons behind this particular assumption are because we paid an objectively verifiable price for acquiring that particular asset, so there won't be any confusion or ambiguity as to what price should be recorded for the asset. Next one, it is very difficult to determine the current value or price of the asset because the valuation by one expert may not be the same as that of another. Suppose you have a car and after 5 years of using it you want to sell it off in the market. So it may not be the case that all the buyers in the market are ready to pay just one definite price for your car. Next one, because we follow the going concern concept, so what's the need to find out the current value as we do not have to liquidate the business? And last but not the least, as market price keeps changing from time to time, so it would be very difficult to keep track of increase and decrease of the market price. And it can be the case that price of a particular asset fluctuates around 10 times during a particular year. So am I going to change the price of the asset in my books of accounts as and on the price changes in the market? Thus considering the ease and avoiding all the complexity, recording on the basis of the price that was paid to acquire the asset. And because the cost of acquisition relates to the past, that is why it is referred to as historical cost. and we also call it as cost concept. Thus, up till now, the concepts which we have learned are as follows: going concern concept, business entity concept, accrual concept, matching concept, money measurement concept, accounting period concept, and in this session, historical cost concept, and it is also known as cost concept. So let's get on to a quick exercise to test your understanding of the concept explained in this session. So the question for this session is, according to the cost concept, option A, assets are recorded at lower of cost and market value. Option B, assets are recorded by estimating the market value at the time of purchase. Option C, assets are recorded at value paid for acquiring it. And option D, assets are not recorded. You can comment with your answers in the comment section below, and we'll meet soon again in my next session. Till then, have a nice time. Thank you and stay tuned.